Financial crises rarely begin where people expect. Before 2008, attention focused on stock markets and major banks. Few believed that problems inside U.S. housing finance could destabilize the global economy. Modern financial systems are highly interconnected. Stress often emerges quietly in areas considered manageable until liquidity disappears and confidence changes suddenly. Today, several parts of the system show similar characteristics: high leverage, dependence on refinancing, concentration of risk, and reliance on continued liquidity. Commercial real estate, private credit, government debt markets, shadow banking. None of these guarantee crisis on their own. The danger lies in how they connect. This is not a prediction of a specific collapse. It is an examination of where structural fragility may already be building inside modern finance. Financial crises typically emerge from imbalances that expand during periods of stability. Low interest rates encourage borrowing. Asset prices rise. Investors become more comfortable with leverage and risk. Over time, systems adapt to conditions that appear permanent. Modern finance contains multiple areas where this dynamic has developed. Commercial real estate depends heavily on refinancing and stable valuations. Private credit relies on continued borrower performance and investor confidence. Government debt markets depend on stable funding conditions and central bank credibility. At the same time, global financial systems remain highly interconnected through derivatives, repo markets, and collateral chains. This interconnectedness increases efficiency during calm periods, but can transmit stress rapidly when conditions change. The challenge is not identifying risk in isolation. It is understanding how vulnerabilities interact under pressure. Modern financial systems promise resilience through diversification, regulation, and central bank support. Since the global financial crisis, capital requirements have increased. Stress testing has become more common. Liquidity facilities have expanded. Markets therefore assume the system is safer than before. The promise is not that crises will disappear, but that systemic collapse can be contained. At the same time, financial innovation continues. Risk migrates into private markets, shadow banking structures, and alternative funding systems. These areas often operate with less transparency than traditional banks. The system appears stable because visible pressure remains limited, but stability itself can encourage additional leverage and risk-taking. The longer calm conditions persist, the more participants begin treating them as permanent. This is how fragility accumulates gradually rather than suddenly. Several structural trends now define the modern financial environment. Global debt levels have expanded significantly over decades. Governments, corporations, and households all rely heavily on borrowing. Interest rates remained historically low for extended periods following the global financial crisis, encouraging leverage across markets. Asset prices benefited from abundant liquidity and investor demand for yield. At the same time, traditional banking became more regulated. As a result, credit activity increasingly migrated into private markets and non-bank institutions. Private credit funds expanded rapidly. Commercial real estate valuations remained elevated. Derivatives markets continued growing in scale. These systems became interconnected through funding markets and collateral structures. The rise was not driven by irrational behavior alone. It reflected rational responses to incentives created by low rates, abundant liquidity, and policy support. But systems optimized for efficiency can become vulnerable when conditions change. The next crisis may not begin with a dramatic collapse. It could begin through tightening liquidity conditions combined with refinancing pressure. Commercial real estate provides one example. Large volumes of debt must be refinanced at higher interest rates while property values remain uncertain. Losses may emerge gradually, particularly within regional banking systems. Private credit presents another area of vulnerability. Many borrowers financed during low-rate environments now face significantly higher borrowing costs. If defaults rise, private funds may face valuation pressure and reduced investor confidence. Government debt markets also matter. As debt levels increase, higher interest rates raise refinancing costs for sovereign issuers. Markets depend heavily on confidence that governments and central banks can maintain stability. The interaction between these sectors is critical. If liquidity tightens broadly, institutions may reduce leverage simultaneously. Funding markets could become stressed. Asset prices could decline. The system does not require widespread insolvency to experience instability. It requires hesitation. Modern finance relies heavily on rollover, the continuous refinancing of debt and funding obligations. If confidence weakens, rollover becomes more difficult. The next crisis is therefore likely to involve liquidity, refinancing, and interconnected leverage rather than a single fraudulent institution. The challenge for policymakers is that interventions which stabilize markets in the short term may encourage additional leverage over time. This creates cycles where stability and fragility coexist. If stress accelerates, markets could experience rapid repricing. Funding spreads may widen. Lending standards could tighten. Institutions dependent on short-term financing might reduce positions quickly. Central banks would likely respond through liquidity facilities and policy adjustments. Governments could support financial institutions or guarantee portions of funding markets. The objective would be to restore confidence before stress becomes systemic. Whether such interventions succeed depends largely on credibility. Modern systems rely heavily on belief that authorities can contain instability. If that belief weakens, volatility can spread rapidly across markets. After crises, financial systems adapt. Regulations change. Market structures evolve. Institutions reduce leverage temporarily. Yet over time, incentives reappear. Capital seeks return. Borrowing expands again. This pattern has repeated across decades. The form of the next crisis may differ from previous ones, but the underlying dynamics remain familiar. Leverage, liquidity dependence, and confidence. Financial crises are rarely caused by a single event. They emerge when systems built on stability encounter conditions they were not designed to handle. The next crisis may not resemble 2008. It may develop more slowly through refinancing pressure and tightening liquidity rather than immediate panic. But the underlying principle remains unchanged. Modern finance is highly interconnected. When confidence weakens, stress travels through those connections quickly. Understanding future crises is therefore not about predicting one exact trigger. It is about recognizing how fragility builds during periods when everything appears stable.